most Wall Street forecasters believing that a soft landing is near, but not all of them do. To break down some possible risks for the market, we have Gary Shilling here. Gary Shilling, and co-founder and president of Gary Shilling. And Gary, thank you so much for joining us here. I know that you are pricing in a big potential risk when it comes to commercial real estate, and you predicted the housing market collapse in 2008. What similarities are you seeing between these two factors here?
Well, the commercial real estate is not nearly as big as the subprime mortgage market was back then. It is really falling apart. There's a lot of pain, but it's much more restricted. You look back then, and a huge number of people in the country were involved in subprime mortgages and really suffered as a result. The commercial real estate, you've got the severe problem with office buildings that are half empty and people who don't want to go back to work in their offices and so on. And those affected are in trouble. But as I say, it doesn't mean there is any less pain intensity, but it means it's not nearly as widespread.
So, Gary, when you're talking about the potential fallout of that, I guess more specifically, how big of an impact do you see that having on the broader market?
I don't think it's not enough to sink the ship. I mean, if you look at the subprime mortgage fiasco in 2008, it gave us the most serious recession since the 1930s and all its ramifications. I think now the economy is vulnerable. This is certainly a negative. You've got a lot of other things indicating that: inverted yield curve, leading indicators being weak, et cetera, the Fed's interest rate increases and so on. But again, it's just not the same order of magnitude. Yeah, this could contribute to economic weakness, but it isn't going to give us a global collapse, at least as far as we can see right now.
So, Gary, what does it do then? Because we've been talking about the commercial real estate risk for so long. It just feels like this zombie in the back of the room that you kind of ignore at this point. How concerned do we need to be? I mean, if you had to put a number on it, how big of a downside risk could this have on financial markets?
Well, I don't know. You said for a long time. I'm not sure how long a long time is. But the last couple of years, this has been clear ever since the pandemic, when people were staying home and office buildings occupancy went down to about 50%. Obviously, it's been a couple of years, but this could potentially knock a percentage point or so off of real GDP. But again, it isn't like the 5 or 6% declines that we saw back with the subprime mortgage collapse. And as you may know, I've made a career out of looking for the hidden flaws, and I've found a few. But this is not one that's big enough to really take the whole economy and financial markets down, in my judgment.
Gary, when you take a look at the residential side of things today, we were just talking to the CEO at Redfin yesterday, and he was telling us that we are starting to see an uptick in inventory, that things are looking a bit better from his perspective. What is your outlook, or how are you looking at the current trends that we're seeing play out in housing? And do you think we're going to get a little bit more activity?
It's a really unusual situation in that what happened, of course, is a lot of people got very low-cost mortgages back before the Fed started raising interest rates, before the pandemic. So they don't want to move, because if they were moved, go to a different house, they get a new mortgage at a much higher rate. So that's really created a lot of desire just to stay put. And it's created a artificial tightness in labor in housing markets, which it won't continue indefinitely, but it certainly is disruptive right now. And what it means is that there is a tightness in the market, that the lack of inventories of used houses for sale and so on and so forth. But again, housing is a very interesting area. People act like there's a huge inventory of people out there just waiting to move into houses. Well, houses are, just by definition, households are formed when people move into a separate dwelling unit. That's the official definition. So you have to have all the forces and indications that want to make people do that. And that includes their financial ability. And right now, if you look at it, 40% or more people simply can't afford housing by any traditional standards, given the high prices and their income levels and so on and so forth. So, to sort of act like this is an evil being imposed on the American people, the economics are there. If people can't afford it, they can't afford it.
But Gary, you bring up a great point, which is that 40% of people aren't in a position to buy a home, which begs the question of whether or not the Federal Reserve's rate hiking cycle is having an impact on the American consumer if they've given up on the idea of being able to buy a house anyway, which is impacted by, of course, the real interest rate there. So I'm curious then, as an economist yourself, what do you make of the actual real impact of the Federal Reserve's really aggressive rate hike cycle?
Well, the Fed raised rates to slow the economy. I mean, they didn't do this just because they didn't have anything else to do. I mean, the whole idea and housing is perhaps the most vulnerable aspect of the economy to interest rates because it's so highly leveraged. I mean, you look at an FHA loan, 3% down. That's a 33 1/3 times leverage. So it really doesn't take much in the change in the price of the loan or interest rates to make a huge difference in people's ability to afford houses. So it's a very it's probably the most sensitive area to the Fed action. So it's no great surprise that we've seen this. And as I say, on top of that, you had all these people who had the earlier low rate mortgages before the pandemic. So it's kind of a perfect storm kind of situation.
And Gary, going off that, the conversation, the debate that's really been dominating Wall Street now for several months has been Fed policy and the timing here that we could see of that first rate cut. I'm curious what you think is ahead, or what you think the CPI print that we got yesterday, how that is going to factor in to the Fed's timing of rate cuts, and what you think is the likely activity here between now and year end.
Well, everybody gets all excited about when the Fed is going to cut rates. And, if you go back a month or so, it was 6 times this year. Now it's down to 3 times, which is basically what the Fed has been saying. But bear in mind that the Fed doesn't cut rates in a vacuum. They cut rates because they see the economy weak enough that they can stand lower rates without rekindling inflation. That's what there is. It's not as though they just are up there saying, "Oh, well, we're Zeus on high, and we're going to cut rates because we think that'd be a good thing to do." So you have to look at what are the circumstances here, and bear in mind that the Fed was really behind the curve earlier. You look back before Powell came in as chairman, you had this series of 3 predecessors who were really in the put business, the Greenspan put, the Bernanke put, the Yellen put, meaning Wall Street assumed that any problems could be unloaded on the Fed. So they had that. He was behind the 8 ball. And then also early in 2022, the Fed was slow to recognize the burst of inflation. As a matter of fact, they only started raising interest rates in March of 2022. And that was only 3 months before the CPI peaked at 9.1% increase year over year. So the Fed was really behind the curve. And that meant that to reestablish credibility, which is very important to the Fed, because if they lose credibility, then they've got a serious problem. But it meant that they had to be extra vigilant. So I think that that's one of the reasons that the Fed is going to be, and I've been saying this for the last year or more, the Fed is going to be very slow to cut interest rates. The other reason is that the labor markets have not responded to the Fed in terms of weakness. A lot of that was because employers had so much trouble hiring people earlier during the labor shortage period that they're very reluctant to lay them off.
Right.
And that's really the ultimate key is employment. If you have labor markets as strong as they have been, this does not induce the Fed to reduce rates. It produces income. Okay, people spend the money. That's all and good. But it doesn't mean that the economy is showing the kind of restraint that the Fed wants to see. So I think all these things suggest to me that we're going to see the Fed continue to be basically tight throughout this year.